Welcome to Chapter 1, where we're diving headfirst into the world of tax brackets. Now you might be wondering, what's a tax bracket? Well, it's not something you hang on your wall. It's actually a range of income amounts that are taxed at a specific rate. In the United States, we operate on what's known as a progressive tax system. This means the more money you make, the higher your tax rate. Starting at 10%, the tax rate increases through several brackets until it tops out at 37% for the highest earners. But don't panic yet. Just because you fall into a higher bracket doesn't mean all your income is taxed at that rate. Here's where things get interesting. Each tax bracket only applies to the income within that range. So if you're in the 22% bracket, only the income falling within that bracket's range is taxed at 22%. The rest of your income is taxed at the lower rates of the brackets below. It's like climbing a staircase where each step represents a new bracket. You start at the bottom and work your way up, paying each bracket's tax rate on the way. Understanding tax brackets is crucial to smart financial planning. For instance, if you're on the cusp of a higher bracket, you might think twice before taking on additional taxable income. Alternatively, if you're safely in the middle of a bracket, you might decide it's a good time to cash in some investments or ask for that raise. Remember, every financial decision you make could potentially affect your tax bracket and consequently, the amount of tax you pay. So, it's worth taking the time to understand where you stand. And with that, you're officially a tax bracket whiz. But hold on tight because we're just getting started. Welcome to Chapter 2, where we're going on a hunt for deductions and credits. Picture them as hidden treasures, waiting to be discovered in the vast landscape of your tax returns. They're your secret weapons to reducing the amount of tax you owe, and who doesn't love holding on to more of their hard-earned money? So, let's dig into the treasure chest. First up, deductions. These are certain expenses that you can subtract from your taxable income. Think of it as a discount on your tax bill. There are countless deductions available, from student loan interest to medical expenses. The trick is to keep track of these expenses throughout the year, so you're ready to claim them come tax time. Now, let's unearth credits, the crown jewels of the tax world. Unlike deductions, which reduce the amount of income subject to tax, credits directly cut down your tax bill, dollar for dollar. They're like gift cards from Uncle Sam, reducing the amount you owe and in some cases even granting you a refund. There are several types of credits, including the child tax credit, the earned income tax credit, and the lifetime learning credit. But wait, there's more. Some credits are refundable, meaning if they reduce your tax bill to less than zero, you get the excess amount as a refund. Now that's a treasure worth hunting. To maximize these benefits, the key is to understand what deductions and credits apply to your situation. Do your homework, consult with a tax professional, or use tax software that can guide you through the process. And remember, tax laws change, and so do the available deductions and credits. It's crucial to stay updated to ensure you're claiming all the treasures you're entitled to. Well done, treasure hunters! You've just unlocked the secret to saving big on your taxes. But don't go anywhere. We've got more gems to discover. Welcome to Chapter 3, where your love life meets your tax life. Our relationship status, whether single, married, or somewhere in between, has a surprising impact on our tax life. So, let's break it down. If you're single, you fall into the single filing status. It's pretty straightforward, but here's a pro tip. If you're a single parent or take care of a dependent, you might qualify for head of household status, which comes with a higher standard deduction. Now, if you're married, you've got options. You can file jointly as married filing jointly, where you and your spouse combine your income and deductions. This can often lower your tax bill, but it also means you're both responsible for any tax due. Alternatively, you might choose married filing separately, where you and your spouse file your own tax returns. This might result in higher taxes, but can be beneficial in certain situations, like if one of you has a significant itemized deduction. Now, what if your status is, well, complicated? If you're separated but not yet divorced, you'll likely still file as married. But if you're widowed, you might qualify for qualifying widow-R status, which allows you to use the married filing jointly tax rates and highest standard deduction for 2 years after your spouse's death. So how do you choose the best filing status? Start by understanding your situation and the benefits each status offers. Consider consulting with a tax professional if your situation is complex. Remember, the goal is to legally minimize your tax liability and maximize your refund. And there you have it. No matter your relationship status, you've got the knowledge to make it work for your wallet. But we're not done yet. Stay tuned for more. Welcome to Chapter 4, Freelancers and Entrepreneurs. This one's for you. Being your own boss is empowering, but it comes with its own set of challenges, especially when tax season rolls around. Navigating the maze of self-employment taxes can be tricky, but don't worry, we're here to guide you through it. First things first, let's talk about self-employment tax, which is essentially Social Security and Medicare taxes combined. Typically, an employer would handle half of these for you, but when you're self-employed, you're playing both roles, the employer and the employee. So, yeah, you're footing the bill for both halves, but don't panic just yet. Remember, this is also a deductible expense, meaning you can subtract a portion of it from your income tax. Now, let's move on to deductions. A freelancer's best friend. There's a good chance you're eligible for deductions you didn't even know existed. Home office expenses, travel costs, even software and subscriptions necessary for your work. All these and more can be deducted, reducing your taxable income. So keep those receipts and make your expenses work for you. Next up is estimated tax payments. Since you don't have an employer withholding taxes from your paycheck, it's on you to make estimated tax payments throughout the year. These are due quarterly, and missing them can result in penalties. So mark your calendars and set those reminders. Lastly, don't forget about record keeping. Good record keeping is the key to managing your taxes effectively. It can help you track your income and expenses, prepare your tax returns, and even support items reported on your tax returns in case of an audit. Remember, everyone's tax situation is unique. If you're feeling overwhelmed, consider working with a tax professional who can provide guidance tailored to your specific needs. And that's a wrap on self-employment taxes. You're well on your way to becoming a tax-savvy hustler, but don't leave just yet. We've got one more chapter to go. Welcome to our final chapter where we're tackling the A word head-on. Don't worry, you've got this. Audits. Even the word can seem daunting, but what if I told you it's not as terrifying as it sounds? Let's break it down together. An audit is simply a review of your financial accounts and transactions to ensure that everything's above board. They're conducted for a variety of reasons. Maybe your numbers don't quite add up, or perhaps you've been randomly selected. It's not necessarily a sign that you've done something wrong. Now let's talk about preparation. Your best defense against an audit is to keep accurate, organized records of your financial transactions. This includes receipts, invoices, and any other documentation related to income or deductions. So if you're not already doing so, start today. Trust me, your future self will thank you. If the audit train does pull into your station, don't panic. First, you'll receive a notice from the tax authorities. This isn't an invitation to a tea party, but it's not a prison sentence either. It's simply a request for additional information. Here's a pro tip. Consider seeking professional help. A tax professional can guide you through the process and ensure you're not going at it alone. When you're in the thick of it, remember to stay calm and cooperative. Provide all requested information promptly and accurately. It's not a game of hide and seek. Transparency is your best friend here. And finally, know your rights. You have the right to fair treatment and the right to appeal any decision. You're not alone in this, and there are resources available to help you navigate the process. And that's a wrap. You're now prepared to face any audit with confidence. But remember, knowledge is power. So keep learning, keep growing, and keep saving.